On the show today, we'll find out what the true cost of financial crime is in sub-Saharan Africa. As always, you can join the conversation with the hashtag #BeyondMarkets. You can follow my Twitter handle too at Esther Ubudaga. Now, a new Thomson Reuters report says sub-Saharan Africa has a higher percentage of companies affected by fraud, theft, money laundering, or other financial crimes than the global average. Now, the report highlights that companies in sub-Saharan Africa lost about 3.6% of their turnover to bribery and corruption, while 3.4% of the regional turnover is spent on combating financial crime. Michael Meadon, market developer at Thomson Reuters, joins me for this discussion. Michael, thank you so much for taking the time out to join us.
My pleasure. Thanks for having me.
I think a good place to start will be how we define financial crime. And I know that stated in the report, it says that for the benefit or for the purpose of the report, you had to expand the scope of how you define financial crime. Tell us about that.
Sure, absolutely. So financial crime is a relatively broad concept, and for the purposes of the report, it includes fraud, money laundering, theft, bribery, corruption, cybercrime is a big one, and then also slavery and human trafficking. So those are the main ones we focused on, and it's a massive problem globally. So from this report, we're estimating $1.5 trillion is lost in turnover annually by companies, and that's just the lost turnover. There's another cost on top of that in terms of the indirect social cost to taxation to people, and of course the cost of compliance, all the money companies spend on trying to prevent being victims of cybercrime, for example. So it's a truly enormous problem, and one that deserves sustained attention. It's one of the reasons Thomson Reuters is so closely involved with these problems both with helping our clients and also in advocacy and thought leadership.
Now, looking across some of the key highlights of the report, because I found it quite interesting. Now, one part of the report states that an astonishing 41% known instances of financial crimes go unreported by these companies, especially either internally or externally. And help us understand why this is. So when the companies know the kind of cost that comes to them at the end of the day.
So that was a very surprising finding, and I must say, when I saw that finding myself, I was a little bit taken aback. I didn't think the figure would be quite that high. One of the other findings that we did have, though, is that tempers that, is that the percentage of companies that report being victims of these crimes does climb a little bit in public companies, so listed companies. So that speaks to, I guess, publicly traded companies being somewhat more transparent. So that's good news. And I guess the primary driver for why companies are potentially underreporting this is probably twofold. The first is reputational damage. So if you've been a victim of a big cybercrime, and we've seen several instances of this in the last couple of years, the temptation is maybe to hide it a little bit or cover it up or not admit the full extent. And there are a couple of examples of those. And then secondly, also, it might expose you to regulatory action if you discover perhaps your insurance company was used to defraud someone or something bad happened. You might not want to report that because a regulator will then ask you tough questions.
Now, let's take a step back. I want us to create a scenario here, for the benefit of a better understanding. You mentioned bribery and corruption, money laundering, but bribery and corruption and cybercrime, a big part of how companies feel that they've been victims of financial crime. Now, what would a typical scenario be like? You've mentioned insurance companies being used to defraud customers. Would you say that there are instances where, for instance, because that would appear to be the situation that I've heard happens here in Nigeria, where a public company wants to get a contract from a government organization or government agency, and they have to pay some kind of fee that's off the record, if you will, to get that contract? Are those the kind of instances that we're talking about when we say that companies say that they face issues of bribery and corruption, especially third-party relationships?
Absolutely, and public procurement is one of the main channels through which corruption happens. And public servants, and this, again, to emphasize, this is something that happens globally. You might know there's a scandal in Spain at the moment, for example, with people allegedly with tender irregularities. And a typical scenario that happens, and it does vary significantly, but if there's some kind of a public procurement, especially a big piece of work that needs to be done for the government, a road needs to be built, it's infrastructure, it's a port, it's an airport, or it's some kind of big software system the government needs, companies often feel the need or are tempted to pay an off-the-books bribe to win that particular type of business. And that is a huge issue, and it's massive globally. The IMF estimates in the range of $1.5 to $2 trillion is lost to bribery and corruption through that channel on an annual basis. So that's a substantial avenue for this financial crime to happen. There's also a very big problem of slavery in supply chains. And one of the other findings from the report is there's probably an underappreciation of how impacted companies are by slavery. So only 4% of companies actually said they thought they were being impacted by slavery. But as the great work CNN has done in North Africa recently, and many others, including Reuters reporters all over the world, slavery is a very serious problem globally. And I think companies are very likely underestimating the extent to which they actually have slavery in their own supply chains. And unfortunately, not nearly enough of companies are doing the due diligence in their supply chains. So less than half of companies are actually on a consistent basis screening their supply chain to make sure that they're not doing business with companies that procure from people who at the end of the day have slaves in their supply chain. And they're estimated to be 40 million plus slaves in the world, right? So it's a huge problem as well.
Okay, we'll come to the issue of slavery. Let's stick with bribery, the issue of bribery and corruption, cybercrime. Now, many of these companies, organizations, either in sub-Saharan Africa or globally, have compliance teams within their organizations. Is it possible that the pressure that many of these organizations face to increase turnover, increase the bottom line profits, and expand markets has weakened the need for these compliance teams to be very effective, especially checking out third-party relationships?
So I think the pressure to be profitable, to increase turnover, to increase your profits has pretty much always been there. And there has long been, and again, this is a global problem, a tension, I guess, between that profit motive and doing the right thing, or doing good and doing well at the same time. And compliance departments are sometimes seen as a blocker to doing business, which isn't the right way of seeing them, but I'm just saying historically that has been. And that is one of the findings of our report. So, so in terms of the global report, 80% of the respondents report extreme or significant pressure to increase turnover. But the good news is, and there is good news, is that 71% report facing extreme or very strong pressure to also improve their compliance. And in Nigeria, 91% of the people interviewed said they are feeling increasing pressure from institutional investors. So I guess there are, the trend is actually towards greater compliance and greater emphasis on compliance, including from regulators, from customers, as it becomes a widely known problem, and also from institutional investors. So I definitely seen in the last 5 years or so in Africa specifically a much more robust attitude to bribery and corruption. And you might know that the Central Bank of Nigeria recently released new regulations that will impose personalized fines on board members, for example, for not providing adequate financing for compliance departments. So there are definitely very, very strong trends towards better compliance globally, including in Africa.
Now, Michael, that being said, I mean, something else in this report caught my eye, where it highlights that there's a further hidden cost, the opportunity cost that results when organizations avoid doing business with high-risk customers because they feel unable to identify actual risk. Could you shed more light on that for us?
Absolutely. So that's something called derisking. It's instead of taking on a risk and managing it, so having you recognize the situation as potentially risky and you've got various mitigation measures in place, you avoid the situation entirely. So an example would be an American investor saying, oh, Africa, that sounds very dangerous, I'm not investing at all, so I'm avoiding the situation, which isn't a positive situation at all. It's not a positive way of handling that type of situation. And what is extremely important to mitigate that or to change that attitude is data and knowledge and transparency. And obviously, as you might know, that's where Thomson Reuters focuses our attention, is making financial transactions and global markets and compliance departments more transparent, and it's more obvious what steps can be taken to mitigate risks. And in fact, it's been identified by the G20, by FATF and other international bodies that this de-risking trend, even in banking, is a problem, for example, for dollar clearing. And we've come across several instances where African banks have lost their last dollar clearing relationship because the corresponding bank doesn't feel comfortable doing business with them.
Now, obviously, this is a global problem. It's not just it's not an Africa thing. We're seeing the numbers across the globe. Now, back to that number where that says 41% of known instances go unreported, either internally or externally. What do you think? And I hear you when you say that the indications point to the fact that things could get better. Companies are actually willing to improve these numbers. But what would you say, in your opinion, could move the needle? Would it be better collaboration? But what is that one thing that you think could move that needle?
So I'm afraid I can't give you one thing. So I'll give you a couple of things, but I'll be brief. So the first thing is consciousness raising. I like this term a lot, is making sure that people, compliance officers and procurement officers and compliance and CEOs and average citizens and consumers all know that these problems occur and that financial crime is not a victimless crime. There are slaves in the world. I don't think anyone wants to consume a good produced by a slave. No one wants that on their conscience. Nobody wants to know that the government is making decisions in terms of procurement because of a back payment to someone's back pocket. So number one is education and letting people know that this is a problem, so that you can put pressure on people they do business with, internally, externally, and also on companies they do business with themselves. So education is a very important one. The second one is definitely regulation. So I think governments have been doing more. There's much more that can be done, including in requiring companies to do more due diligence with their supply chains. This is a very serious problem. We've seen some governments do it. In the UK, for example, we've got the Modern Slavery Act as one example, but there's much more that can be done. But I guess overall I'd say there's those two. It's putting more pressure in its knowledge, and there's also the governments doing more to combat these problems.
Okay, Michael, we'll take a quick break. We thank you for your time so far as we're continuing our discussion on the cost of financial crime in sub-Saharan Africa. Still with me is Michael Meadon, market developer at Thomson Reuters. Michael, thank you for your time so far.
Pleasure.
Well, let's look at other aspects of financial crime. You mentioned human trafficking and modern-day slavery. Now, part of this report, another aspect that caught my attention, where some organizations, some of the respondents said that they feel that what they feel are the most important to prevent organizations. I beg your pardon, they didn't think that slavery or human trafficking was that important. Looking at the rankings, that came in right at the bottom. And you say that, at least the report highlights that that was a problem. Could you shed more light on that for us?
Absolutely. I think that's one where consciousness raising needs to really be done. And I've been on CNBC previously talking about exactly this topic. And I think the reports that CNN did last year, I think for the first time in recent years, threw a real spotlight on this particular problem, and the shocking images of people being treated like chattel and sold at an auction, I think shocked people into realizing that it's not a problem of the 1850s, it's a problem of 2018. And by one estimate, there are more slaves today than there have ever been in the world. And not a lot of people know that. So I talk to audiences about this particular problem, and people are often shocked when I say things like that. Of course, these are all estimates. We don't know the precise number. But as I said a bit earlier, upwards of 40 million slaves. The International Labour Organization estimates $150 billion of profits being made from these people. And there are a couple of misconceptions about it. So I think people's minds immediately go towards human trafficking and the sex trade. And that is indeed a very big problem and a heinous crime. But the majority of slaves actually aren't either in the sex trade or trafficked. They're kept in situ and used for their labor, primarily in kind of primary production industries, things like sugarcane and coffee and bricks and mining and so on and so forth. And I'll give you a specific example. There's a huge problem in Ghana around Lake Volta with slaves being used in the fishing industry. Same problem in Southeast Asia, in the shrimping industry, where people are stuck in the ocean on a boat and they never dock, they never leave. And they're just forced to work, all the time. And I think retailers who are the possible recipients of those shrimp might want to know about this fact and might want to put in steps to mitigate those risks. And it's never the case that I think a responsible corporation will, knowingly buy shrimp from a slave trader. The problem is it's a very complicated web. So it's the slave traders sell to a distributor who sell to an exporter who sell to an importer who sell to a retailer. So there are many steps in between. So it's the supplier of the supplier of the supplier of the supplier that's the problem. And we've seen those kinds of cases in India with mica production, in the DRC, recent work around cobalt and other rare earth metals. So it's a very challenging problem, and not enough people in corporations know that's a problem. But there are ways to mitigate it. So I always talk about data and due diligence. There is data available. We work very hard to collect and distribute and systematically exclude from supply chains people who are involved in slavery. And companies can use some of those tools to do the same thing.
Now, when the International Labour Organization is able to identify or uncover some of these infractions, because you've mentioned that many of the companies don't appear to know that this is happening. I want to believe that a good number of them probably do know but don't want to take action. But when it's identified at the ILO level, what is the chain of events that should happen in terms of how it now trickles down to the company or the companies involved in those infractions?
So I referred earlier a little bit to the Modern Slavery Act, and there are different countries starting to take the same kinds of actions. So the International Labour Organization does have a program of work around this, including on child labor, which is another very serious problem, as you know. And I think these UN organizations typically have to rely on and work through national governments because they're an intergovernmental organization. And so they'll have a convention, and there is an anti-slavery convention which most of the world has signed up to. It's about enforcing those rules and having a program of action. And I think there's much more traction throughout the world for this notion that we should require companies to at least know whether they're doing business with potential slave traders, and that they should take steps to eliminate anyone who's potentially employing slaves or forced labor or child labor. And it's all about having those regulations in place, and it's starting to happen.
Okay. Now, just how much are companies spending as a percentage of their turnover to perhaps identify and prevent financial crime?
So it's 3.5 odd % according to a report. Obviously, that is an estimate. There are various other estimates roughly in that same range. It amounts to over a $1 trillion, 1.2 odd trillion dollars. So it's a substantial amount of money. I guess the follow-up question is it enough? Arguably not. And there's arguably room to spend more and to take this problem more seriously. And it comes back to this issue of being a responsible corporate citizen, and it becomes also an issue of education, both within corporates and in consumers, so that consumers can know and identify companies that are actually ethical and doing business in the right way and avoid ones that aren't.
Well, like you said, just over 3%. I mean, many might argue that a lot more can be done. That number could go higher. But you get a sense that these corporates will be willing to put more money on the table to prevent financial crime.
Look, it's definitely happening, right? I always say no one, well, not no one, but I guess there's sometimes reluctance, especially on the part of boards, to spend. So people don't buy these compliance systems, don't employ compliance people necessarily because they want to. They typically do it because they feel they have to, either because their investors require it or their customers require it, or their suppliers require it, or the government requires it. It needs to be almost push, right? Because no one wants to give 5% of their turnover away to spend on compliance if they can, to return that to shareholders and make more profit. So I guess it's all about pushing corporates to be more compliant, and those push factors that I've mentioned are very important.
Now let's look at other aspects of the report. Training gaps, that was also identified in the report. What would you say is the state of training within companies that would allow staff of the company to identify, prevent, and report financial crime?
So I would say it's fair to describe it as inadequate. Less than half of companies provide kind of sustained training to their staff on an annual basis, which is clearly unacceptable. It needs to be the first step of any compliance program, is to making sure your entire staff contingent, and that comes all the way from the board, because there has to be a culture of compliance. We talk about tone from the top. And what tone from the top refers to is the board and the senior management team need to take these issues extremely seriously and live up to those values and say, you know what, if I have to pay a bribe to win business, I'd rather not have that business at all. And that takes kind of dedicated leadership to do. And from there, it needs to emanate down to middle management and then to frontline staff and across the entire organization. And if less than half of the companies are training their staff on basic things like anti-bribery and corruption, or on basic things like identifying and avoiding slavery in the supply chain, on things like cybercrime, how to avoid becoming a victim, etc. That there's clearly a big gap. And companies that do provide training, they sometimes do it very inefficiently. So I guess it's partly because I'm a millennial, only just, that I always favor kind of electronic ways of doing this. There's kind of this traditionalist approach. You have a couple of trainers, you fly them all over to your offices and you train people in person for the day. There are much more efficient and effective ways and auditable ways of doing it via e-learning and other technologies. And there's the increased gamification of e-learning to make it more interesting and interactive. It's not just something incredibly painfully boring where you're sitting at your desk staring at a PowerPoint and someone droning. The technology has advanced since then.
Well, let me ask you this. Do you think that corporates, CEOs are getting a lot more nervous about how sophisticated, that's speaking about cybercrime now, are worried nervous about how sophisticated these hackers could get going forward in the future? Because it just appears that many times it would appear that they're a step ahead of many of these corporates, despite the huge amounts of money being spent to update the technology, to update the softwares that protect information or data that a company has. What are your thoughts?
Indeed. So I do think they're becoming increasingly nervous, and for good reason. So there are lots of examples and case studies of people being catastrophically affected by these kinds of intrusions. And as you might know, GDPR, the General Data Protection Regulations of the EU, recently became effective last week. And if there's a data breach, you're potentially paying 4% of your annual turnover in fines as a result of these data breaches. So the consequences, both reputationally and in terms of fines and in terms of lost clients, are very substantial, and criminals are becoming more sophisticated. One of the issues that Europol, for example, has flagged is the rise of something called crime as a service, where you have sophisticated criminal gangs who sell their services to other criminal gangs. So, for example, you pay a hacker with bitcoins based somewhere in Russia, potentially, Ukraine, wherever. You pay them in Bitcoin to go hack a particular system, and they provide nothing but that particular service. Whereas your criminal gang, maybe you're an organized gang and you're doing a whole range of activities, but you're relying on external service providers, criminal service providers. And the internet and Bitcoin and cryptocurrencies are enabling these kinds of transactions happening on the dark web, and it's a very worrying trend.
All right, Michael, we're going to have to leave it there. Thank you so much for your time today, for that insightful look at your report on how sub-Saharan Africa, and of course, indeed, the global world is dealing with the cost of financial crime. I've been speaking to Michael Meadon, market developer at Thomson Reuters.